My name is Kent Scornia, President and CEO of Krilogy, and this is my partner, John MacArthur, the Chief Investment Officer here at Krilogy, and this is your November market update. And John, the famous investor Shelby Davis, said, you make the most of your money in a bear market, you just don't realize it. And, we're approaching a usually strong time for the market. Tell them what your team's seeing. What's on the horizon? What has changed in the market since the last monthly update?
Yes, very, very interesting times in the market as we continue to progress through 2022. From a volatility standpoint, there's only been 2 years in the last 50 where we've seen more 1% moves in the S&P 500, either up or down, and that was 2002 and 2008.
So daily 1% moves?
Daily 1% moves.
Yeah.
So not great company in terms of end result for those years, but to no surprise, we've felt the pain really since the beginning of January. The bond market's down mid-teens, the stock market's down mid to upper teens, and both have been worse. And I think as we look forward, we just want to caution investors from thinking about what they feel should happen. There's a lot of consensus around very low global growth, very high persistent inflation, and it tends to happen when everybody is aligned in similar thinking, something else happens. So sticking to discipline and process an environment like this is really, really important. To highlight an example, two of the better known strategists out there, Mike Wilson at Morgan Stanley and Jeremy Siegel, have a completely different expectation for 2023. Mike Wilson and his team is thinking 3,000 as the ultimate low or thereabout for the S&P, and Jeremy Siegel thinks we're going to get a 15 to 20% increase in the market next year.
On the upside.
So, we are sharpening our pencils and doing a lot of forecasting and modeling as we look at 2023. Jake Thornton and the rest of our team are spending a lot of time on that.
So you mentioned the daily 1% changes in the market. Now you're speaking of equity markets. This is a very unique year because the bond market has been struggling. And typically when the stock market or the equity market has a tough time, the bond market sort of buoys that return. This year is unique because they're both in a challenging moment. What other investment themes are you seeing out there?
Yeah, it's very unique, and we would caution to have investors not abort their fixed income. We've likely seen peak yields. We could see a little bit higher. The 10-year hit 4.3% at the highest. It's about 3.75%. So, in short order, we've seen a decline in yields. I think that the bond market is really signaling that the Fed's going to overdo it. And if we have a recession in 2023, yields are likely to depress much lower, and that's good for bond investors. In terms of other themes, our director of technical research, Jamie Setley, highlighted in a note not too long ago that identified value finally breaking out in relative performance in a pretty compelling way relative to growth. Growth has been an outperformer since 2006 relative to value. And we've seen instances in 2013, 14, and 16, and even earlier this May, when looking at long-term trends, again, in his work in technical research, and all of those instances were failed breakouts of value until October. So, our thinking is when we align really kind of our baseline in the work that we do from the fundamental perspective, what we're seeing from corporations and earnings, we're really seeing those companies from the value and cyclical side of the market performing quite well. You've got companies like Caterpillar at 52-week highs or close to it.
Yeah, and that's a result of the Fed really increasing the interest rates. Growth companies benefit when the Fed drops interest rates, right? Because they're highly leveraged.
That's right. Easy monetary policy now for going back to 2009, and we're in a different era. So investors, it's wise not to anchor on what worked in the past. It's likely that we'll see a continuation of new leadership, and we're just starting to see it. on a year-to-date basis, if we look at large cap value relative to large cap growth, I mean, large cap growth is down nearly 30% year-to-date.
Yeah.
Large cap value is 5, 6, 7% to the
Right.
negative. And
So that
Yeah.
large cap growth led us all those years,
It
right?
did.
On the
It
upside,
did.
but it's also
Yeah.
leading us on the downside as well.
yeah, so we're starting to see really good alignment with the fundamental work that we do, which is the lion's share of our work, and then an overlay of Jamie Setley's technical work is really aligning. I think worth noting as it relates to passive investing and S&P index construction. If we add the quote unquote value segments of the market, so think about energy, materials, industrials, financials. If we add the sum of those weightings, they equal pretty close the technology exposure in the S&P index. Call it 27%,
Right.
give or take.
Because that's not an equally weighted index.
That's exactly right.
That's right,
That's
yeah.
exactly right, which is why you can see underneath the surface of the index, you can see pretty meaningful outperformance in certain segments. But the financial media and everything else highlights what the index itself is doing, which is tech heavy.
Absolutely. So we brought up the F word, which is the Fed.
Yeah. Right.
And the Fed has a meeting here the next 2.5 to 3 weeks. What's going to happen in that meeting?
So yeah, they meet the 13th and 14th of December. Interestingly, we get CPI data, which is really important, the measure of inflation most recently, kind of in the throes of that meeting. So it'll be interesting to see, if and how it's addressed. It's unlikely to be, but the trend from last month was encouraging.
Yep.
The weight of the evidence suggests that peak is behind us. Now it's a question of where do we go from
Are we
here?
leveling off?
We're leveling off.
Yes,
Yeah, we're seeing
exactly.
a pretty
Are we-
good disconnect between goods and services. The service side of the economy, as we all kind of firsthand experience, is the demand is strong, and then the goods side of the equation is rolling over. So.
Yeah. So tell us what could go right and what could go wrong.
There's a number of aspects from a 2023 perspective, especially. If we continue to see softer, core CPI, core inflationary numbers, that's a really welcome sign that would suggest that the Fed's work is close to being done. Candidly, we could see a hike here in December, which will likely see 50 or 75 basis points to your question. Maybe we see a little bit more tightening early next year, but there's plenty of signs that the rate hikes are taking hold. So, in a world where there's so much pessimism and negativity, all we need is some surprisingly good news, along the way.
I think that's the interesting part about the market, because the moment that happens, if you're sitting around thinking, oh, I will wait for the stock market to come back.
Right.
The moment we get some good readings in inflation and some of those numbers, and the Fed gives a half a hint
That's
of
right.
a signal that they
That's
are
right.
going to pause,
That's right.
the market's going to break out at a pretty high level.
Yeah, theoretically sure should, because we'll likely see a decline, peak declines in the market prior to peak declines in both data and earnings.
Yeah.
And we have some tougher periods to work through here yet as the rate hikes continue to show up. We're seeing earnings still being revised downward. That trend is likely going to continue into Q1. And we'll see how the market has discounted that or not. We feel like we've seen a majority of it. There could be some work left to do, but definitely not the time to jump ship at this point.
And that scenario I just spoke of may not happen for quite some time.
That's right. That's
There's
exactly right.
no way to predict when that moment's going to happen.
That's exactly right.
We do know that eventually it probably will happen.
Right.
It's quite a long time off.
That's exactly right. Could be months, quarters. Yeah, absolutely.
What are some key things that investors should focus on looking for the next 6 months, 1 year, 2 years, and beyond?
Yeah, I think really for the next couple of months, not even a couple of months, the next 5 weeks, I think year end is a good opportunity in a year like this where stocks and bonds are varying degrees of bad, to really look at tax loss harvesting opportunities.
Yep.
From a tax perspective, you can realize some losses without losing out on market exposure in certain areas. You take advantage of that. You can also take a chance to revisit what you own. I would contend that this value theme, dividend payers, better valuations is likely more of a secular trend, multi-year perspective. And so looking at quality, looking at dividend payers, I think is a good place to be continually here going forward. I think, looking at risk budgeting from the portfolio construction process is really important. So think about your equity exposure in terms of ranges, and having a process for being either light or heavy on equities depending on the environment that we're in.
So risk-adjusted return is what you're speaking to there.
Yeah.
How much return are you getting relative to the risk that you are taking, right?
That's right. Yeah, really important to have a feel for that, or work with an advisor that has a feel for that, for sure.
And for years, the large cap growth category just took off at such a high rate. That tax loss harvesting, that's sort of a targeted space you can really focus in on that, and trying to realize some of those gains, or really at this point realize some of those losses potentially.
Right. That's exactly right.
Anything else out there on the horizon?
Yeah, the last thing I would mention is just to be mindful of the behavioral impact and influence that we as human beings in the investing process and the overlay there. So anchoring on what's worked in the past, what's worked in the recent past, and just recognizing that even though Microsoft and Apple may have been great names for us in the past, doesn't necessarily mean that there'll be leadership going forward. Not recommendations or suggesting those companies don't fit in a portfolio, but just to look more broadly in terms of what you own and
well, the market's an evolving ecosystem with leaders, right?
That's right.
And leadership in certain time periods, and you're saying that the shift in leadership is happening.
That's right.
I mean, we can all go through the list of companies out there that have led the U.S. economy for years and are now maybe potentially no longer in business.
Sure.
I think that's
right.
what you're sort of alluding to there. So,
Yeah.
Well, with that, I just want to thank you, John, on behalf of John MacArthur and myself. I want to thank you for your time today. We want to wish you and your families a wonderful Thanksgiving, and have a great day. Thank you.